I'm Bill Goulding in the finance program. I'm going to talk about some of the way we've regulated big banks in the post-crisis era. This is actually a pretty simple paper with a lot of moving parts, so I'll do my best to kind of build a bridge quickly over all the weeds and get to a couple of the main results in the paper. I'll first point you towards the disclaimer from the CFTC, who was kind enough to let me use some of their data in the project. So, motivation. One of the primary things that happened during the financial crisis was a lot of stress on big banks from losses owing from defaults or stress of trading parties, in particular in derivatives markets. The nature of this risk is if you think I open a derivative, I sign a contract that has some payoff contingency in the future with a counterparty. If that counterparty isn't there at the time it's supposed to pay off, I've lost everything that the contract was supposed to pay me. So to the extent that banks carry the mark-to-market value of these contracts on their balance sheets, when a counterparty goes down, they've lost a substantial amount of asset value flowing from not really a change in the value of the derivative, but a change in the creditworthiness of the counterparty. So that happens both in the case of default and the case of just the counterparty becoming much more risky, in which case they need to mark down the value of the derivatives positions, or other contracts really, based upon a reevaluation of the credit risk of that counterparty. Right? This is really kind of a treacherous thing, economically speaking, because if you think, it can really have a spiral effect, right? One counterparty becomes imperiled, the guy trading with that initial counterparty loses a substantial asset value flowing to markdown of those positions, the second bank becomes imperiled. So this was a really big problem. A good example is the Lehman Brothers failure, which we're still litigating. So trying to look at these risks, the regulators have introduced a number of new constraints on bank balance sheets. We're going to think about what that means. So, the fruit is actually quite low-hanging here. First, we want to think about how this affects the way we price financial assets. Then we want to think about how the costs of these regulations are transmitted through the economy, whether it's even across counterparties. And, ideally, we'd like to sort of get our arms around quantifying this a little bit. The empirical challenge that I'm trying to solve here is clear, right? If you just naively run a regression of sort of trading outcomes or valuations on some measure of bank capital constraint, you're going to have a really difficult time because you think a bank's capital gets shocked. That's probably going to happen in exactly the same time that something else bad happens in the economy. Very easily get some sort of false correlation between what's going on the bank balance sheet and what the trading outcomes are doing. So you need some way around that. And I'm going to try and provide a way to get around that problem with some microdata. So I'm going to focus on the foreign exchange swap market. For a number of sort of economic and empirical reasons, this is a particularly good place to ask these questions. First, this is one of behind interest rate derivatives. This is the largest over-the-counter derivatives market that banks typically hold on their balance sheet. It is highly intermediated by regulatory banks. Above 90% of the global universe of trades go through a bank on one end of the trade that has regulation of the form I'm going to look at. And the contracts are actually quite simple, which means that we can get pretty close to an empirical statement without doing a whole lot of manipulation of the pricing data. And this last piece I'm going to be much more specific about. Okay. So what is a foreign exchange swap? It's actually quite a simple derivative contract. It has two exchanges of notional, one at initiation, one at closure of the contract. So you can think about two loans simultaneously happening in different currencies. When the loan opens, I, for instance, swap dollars with a counterparty for euros. So if I'm a US guy swapping dollars for euros, I send dollars to my counterparty sends euros to me. The contract is open for a period of time. At closure, we do the opposite swap. The important part here is this F on the right side we've agreed upon when we initiate the contract. So we know exactly the exchange rate that we're going to swap back at when we sign the contract. What this does for us economically is it allows us to make these two simultaneous loans in different currencies with no exchange rate risk, which is very valuable to somebody who, is a corporate facing exchange rate risk. So to think about how we want to price these things, we need just a little bit of sort of finance intuition. Consider this hypothetical portfolio where I start out and I borrow 1 unit at the domestic rate. So I borrow it at the risk-free rate in dollars, and I agree to pay it back at RD. So RD is the gross risk-free rate in dollars in 1 year. I immediately swap it into a foreign currency. So I borrow $1, then I swap it into euros at the prevailing spot currency rate, and then I invest it in a euro bond. I'm going to earn the rate RF on the euro bond. So I'm going to have these net cash flows in 1 year, which are going to be $1 times the rate that I swapped at times the risk-free rate in euros minus the rate that I'm paying back on my borrowing in dollars. The problem here is we've got this unknown rate in 1 year where we're going to have to exchange all the euros that we have in 1 year back into dollars. What the swap allows us to do is enter this contract that gives us F. So at the time we initiate this trade, we can know exactly what our payoff is going to be in 1 year. And we can say that we pay a bank V0 to put this trade on with us. We can think about what our net cash flows are going to be 1 year then. We've got F, and then we have paid the V today. Essentially, we've created, extrapolating from counterparty risk, a risk-free security. This must, sort of by law of one price, earn the risk-free rate in dollars, else we could do something clever to manipulate the prices, and that's not going to be a stable equilibrium. By convention, we can bring this around and we can say that this is what the price of this contract should be, assuming there's one price in the economy between the bond markets and the swap markets. And we can get a one-for-one function between the forward rate and the current valuation that we would have to pay today. By convention, these trade at 0 up front, just to make things easier. So an example here, really quickly, if I enter this euro-dollar trade today, I need to know the interest rates in the US dollars and the euros. I need to know today's spot rate. That will give me, by setting this equation to 0, the prevailing forward rate today. And then I can let it sit on my books for 6 months and think about what the valuation should be then. I've already fixed this rate. So the value in 6 months is going to have to correspond to that V0, which will have floated away from 0 because the prevailing forward rate will no longer correspond to V0. I've held the exchange or the interest rates fixed here and just let the spot rate float. And what I want to show you is that as this moves away, we can get a positive or negative mark-to-market value depending on whether the prevailing exchange rates move for us or against us. So what do I want you to know thus far? I want you to know this is a simple contract, 2 exchanges of notional. It moves with the spot rate, and it goes on book at 0 mark-to-market value. What's a little bit weird about that is by construction, there should be no balance sheet impact of entering this contract. Zero asset value, equity holders change, or on book, equity holders claim doesn't move. The fact that we have to hold regulatory capital against this creates a wedge because holding regulatory capital against the counterparty risk in this contract implies a change in the asset value on book that would not be there otherwise. And this changes the pricing of these contracts. So we want to think about exactly what the regulatory capital required is. It's actually quite simple for a foreign exchange swap. It's this formula, where these two are given by the regulator, and Z is a measure of exposure outstanding to the same counterparty. What this tells us is the cost in terms of units of regulatory capital that I would have to hold against a new trade with the same counterparty are generated by the mark-to-market valuations of the outstanding positions I have with the same counterparty. What am I building up here is if you buy the mark-to-market valuations of my exposure to that counterparty are driven by the path of exchange rates, there's a strong random component to the path of exchange rates. That means that the amount of regulatory capital that I have to hold against that new trade has a random component flowing from the randomness in the path of exchange rates. So we can then think about the randomness assigned in the cost of capital against these contracts. Using that same example we had before, if we just have one open trade with the same counterparty and we want to enter a new trade, this is going to be binary. Z is going to switch on or off. And as soon as I have an in-the-money position, which means I'll lose money if that guy goes down, I have to hold this 60% additional capital. More generally, as I build up the mark-to-market exposures to that counterparty, I have a functional form that looks like this as a function of the exposure to the same counterparty. So what I'm going to do is exploit this functional form to look at the changes in trading behavior to the left and the right of 0 in this line. And I'm going to do this because I shouldn't be able to convince you that banks are not smart enough to understand that this is going on, but they are smart enough to not be able to sort of exploit the randomness around the kink. So outcomes look the same way. In a regression, we can see that this actually affects trading behavior in terms of both notionals and prices. And as it turns out, most of the cost of regulatory capital is put into the pricing of these contracts.